We're going to stay on the theme here, bringing in Carl Weinberg. He is the chief economist at High Frequency Economics. He's with us on the telephone. Carl, thanks so much for joining us this snowy morning via phone. Chinese import data, we've been talking about it here, saying the China take, though, less strong, and saying that perhaps the data has been skewed by the Chinese New Year. What do you make of that?
Yeah, absolutely. I mean, I'm going to take issue with a number of the points that you just reported on. You know, first of all, we have a 21% year-over-year rise in China's exports, and that looks like a good thing. But about 25 percentage points has to be taken off, 20 to 25, because of the New Year, which last year shut down exporters in January and didn't affect them this year. But I want to look at the level of that number, because you made the point about capacity in China. At 109 billion yuan in January, exports are still more than 30% lower than their peak in the summer of 2008. So people who are talking about Chinese export industry working, you know, at near capacity and a bubble forming and inflation coming out of overheating economy, you're still 30% below the mark of where they've demonstrated they can produce before. China growing at 10, 12% is normal for them. I don't think you can infer a bubble out of these data.
All right. And Carl, I mean, one thing that Sarah has been covering with us as well is that spike at the end of the trading day for the yuan. And I mean, that's a little bit unusual to see such a big line, is it not?
Yeah, we only have 1 or 2 days in the last 2 months where we've seen that amount of freedom allowed in the market. I don't think it's a change in policy. I just think it's what happens on the day before they break for New Year's holiday and they get a strong number. The markets won last night, but the People's Bank of China has no incentive whatsoever from an economic point of view to let the yuan revalue. China gains nothing from it, and I don't think I'm going to disagree with the other people you quoted, Gartman and El Arian. All right, China's going to hold that yuan peg for as long as they possibly can, and that could be years or even a decade, because they want specifically to keep the yuan strong. They want to be a world financial superpower, and to do that, you got to have a currency that's stable in value rather than one that fluctuates on every whim.
So that's what they're going to do with their currency, in your view, Carl. What about monetary policy? This is something else that we've been discussing and obviously contributes to the big picture.
Yes, and very clearly they're trying to snug up a little bit on credit to specific sectors. All right, they have microeconomic problems, perhaps, in the housing market. I say perhaps because the data is sketchy. We get these reports of 1 million unsold houses in China, but with 10 million people a month moving into the cities, moving into the cities from the farms, that's about a month and a half supply. We have reports of blowing up house prices in the cities, but when we look at the CPI, we see only a 1.7% year-over-year rise in housing costs in the CPI. That inflation threat that you cited in the previous report, that's
Carl,
all food prices.
We have to leave it there.